So we go out, go public, raise the money. The bank that we're putting all the money in doesn't actually exist yet because the bank hasn't approved it. So I'm there on the floor at the New York Stock Exchange on the phone to the bank, trying to get them to finally open up our account. So this, I think it was like $250 million can get wired into it the next day. But you're not allowed your phone on the New York Stock Exchange thing as well. So I'm sneaking around underneath all of the various different trading desks, trying to hide from security, trying to get the bank open so we can actually close the bank account to have the funds inside.
Hi, Dave. Super excited to have you today in our podcast, Finance Unscripted. So we had our first chat a few months back, and it was just incredible hearing all of your stories. I thought that it would be fantastic to share some of your insights, experiences that you have over your career with the wider audience. So very excited for this conversation. I think
lovely to be on.
Yeah, so I think one thing that really stood out to me from your career, you were very early in transforming finance functions of a lot of SaaS companies at very sort of like early stages of SaaS into just like a more organized process. There was like a big movement from early stages to making some of the companies public. And now you are at sort of like a similar stage with the AI transformation of the company that is a fairly early stage, and you are building out the finance function from scratch. So I guess the first question I have to you is just very curious, sort of like seeing these two transitions now. Do you see any similarities? Anything sort of like reminding you early stages of SaaS adoption?
Yeah, I guess you're showing my age somewhat here if we go back to the early sort of stages of SaaS here. But I think, back in the early days of SaaS, or even sort of subscriptions or so, when I started getting involved in it, there was a lot of different ways, I guess, that companies were trying to establish not just go to market, but metrics, trying to understand what was important, what good looked like. Back in the day, ARR wasn't a thing. Everyone's sort of familiar with ARR, net retention rates, all those various other SaaS metrics that came out. But in the early days, there were a lot of different ways that companies would try and measure a comparable success. And that was led by, some of the early runners of SaaS, if you look at the Salesforces of this world, but also, I guess, a bunch of the VCs as well, who were trying to, standardize across a bunch of potential portfolio companies so that they could compare, contrast, and look at different ways of bringing investment. So, back then, if you look at what was important within the finance world, it was quite interesting that a lot of accountants had grown up with sort of bread and butter, debits, credits, revenue being a very easy to determine figure, or a very easy to determine understanding. It might have been under ASC 605, which itself was complex, but was understood. As we got into SaaS metrics, and you're starting to talk about ARR, you're starting to talk about bookings, you're starting to talk about a bunch of other quasi finance metrics. There's the sort of mindset of the finance teams were having to shift and adapt to, it's not all just coming out of your finance systems. There are different ways you need to think about tracking contracts or sales. And bridging that down now to AI, I think we're probably entering into a realm again. I see a lot of the, some of these high growth AI companies at the moment, someone like Lovable or ourselves, doing some pretty good growth. And you hear people talking about ARR metrics for Lovable when it's a consumer-facing short-term app also. So I think there's this reinvention again of what's going to matter for AI companies, that we're going to start to see the shift in terms of metrics are different. We've seen huge amounts of growth for a lot of these companies. And applying old school SaaS metrics is probably not going to be the way we're going to end up into the future. I mean, again, it's still very early in the market and we still need to define what we're getting to. But the consumption basis of AI is different to what a lot of mainstream SaaS was, which is built around subscriptions and seats. So you look at there's a bunch of the pricing mechanics out there, and there's a bunch of blogs out there where you look at it. But You've got token-based pricing, you've got usage-based pricing, you've got results-based pricing. There's a whole load of other things where trying to tie the pricing mechanics to the success mechanics is different to signing up to a subscription and having that on a seat basis, which was the old school SaaS way. So I think being in the early stages of this is great because you start to see where the value can come from. And with AI, a lot of the time to value or initial value is quite quick. But the ability to replace it, or the ability for new players to come on board as well, is also very quick as well. So it's a slightly different and at the moment maybe less sticky business, so therefore has slightly different metrics that we need to start to think about.
I have so many questions to ask, but before going there, I wanted to just hear a little bit about your personal story. How did you get to the finance? And you've been growing finance team at lots of great companies. What actually made you to stick and stay and be just like motivated and engaged going on?
Yeah, I think back in the early days, and again, the hair is probably more grey than it is black these days. But back in the early days, I initially wanted to be a software engineer. So when I was going to university and going to university, I initially planned to go to a computer science course. But I probably, and this is probably what it's right for me, the accountants or prudency kicked in at the time. There wasn't quite the explosion in technology back then. The internet was still in its early days. And I took the safer route and went down a sort of more generic business path, leading into training up as an accountant for the few years after that. I spent 3 years as an auditor, following my business degree, and I'd have to say I probably disliked almost all of that period of time. I felt it was in the time in the UK, a lot of smaller companies who needed auditing, and I didn't feel there was much value being passed on to that one. But what I was doing, I was spending some time in I guess the Reading area in the UK, which is kind of at the time the Silicon Valley of the UK. So I was getting exposed to a lot of tech companies. So leaving the audit job, I joined a digital TV startup. It was sort of a name listed company, or so, and I got hooked. I got hooked on the tech side of things. Got hooked on the speed, the pace that things moved at. In a sort of a year and a half that was there, we did something like 15 acquisitions. We moved into 4 or 5 different markets. The fact that you could just expand and explode all around the world. It ultimately wasn't that successful, but the fact that you could move at that pace and everything was new, challenging. It was a brand new sort of arena to operate in. So there wasn't 30, 40, 50 years of history in that particular market. I just really enjoyed it.
Cool, fantastic. So you were building some of the finance teams from early stages. One topic I wanted to discuss is a little bit of philosophy around building the team, and especially now, because I think a lot of assumptions are being challenged, the way how the team is being built with the technological shift that we are actually seeing today. So curious, like if you can just walk me a little bit through, it's like, all right, if we look at the different stages of the company, seed A, B, C, so like what are the first hires? What are they focused in the beginning? How do you actually scale the team now? And what your prediction in terms of this maybe change how we're going to do it in the next wave of technological change?
Yeah, no, I certainly think it's certainly changed over the last couple of decades, and the number of hires that you need has reduced. That's due to a combination of technology being available to do a lot of the heavy lifting. And again, I think as we move through the AI world, and we'll get onto that in a minute, I think that number of heads is going to reduce itself somewhat. If you look at the role at different stages, if you take sort of seed through to Series A or so, at that point in time, depending upon, again, AI is changing the nature of it in terms of some of these large early rounds that are coming into some of these seed and Series A companies in the AI space. But if you go back to sort of the traditional SaaS things, you've got the basic hygiene aspect of things that you need to put in at the very early stage, whether it's a seed, Series A, and that, you can look at maybe even requiring a fractional CFO or something else like that to come in alongside either, an outsourced bookkeeper or some kind of in-source strong generalist. You've got the two challenges that you need there. One is you need to keep the lights on. So you want to build out some of the early processes. You want to make sure that you've got billings going out and that they're getting collected, that you've got your payroll being run. You've got all those basic mechanics. I think in those early stages, the role of the finance professional there is really to help as a combination of guidance counselor, a combination of helping the founders to see more than 1 month ahead, cash flow management aspect of things, because it's easy to get really excited over billings, but then not realize that you've got big collection issues coming in place there, and trying to manage some of the mechanics in and around fundraising, or the mechanics in and around making sure that there's enough capital in the company. The founders are going to be leading the story. They're going to be the visionaries. They're going to be the ones who are going to be pushing things forward. And in that early stages, make sure that nothing breaks, and that your basics are covered. It doesn't need to have to be super sophisticated, but make sure that the founders are not getting swamped in the mechanics of the fundraise. They're not getting swamped in the mechanics of the early stage system implementation, or just putting in back end processes. And I think that sort of covers your early stage. And then your staffing and your requirements often depend upon the speed and scale that you're growing at, and that's where the judgmental approach of having experience comes in quite a lot, because depending upon the pace that you're predicting you're to be growing at, you have to then start to look further and further down the road in terms of what your hiring may need, what your technology requirements may need, not just for within the finance team, but more broadly. Often people have a very much an immediacy bias. So when you start going through planning exercises and start going budget exercising, the standard response is, I need 20 people. I need them today. I don't need anyone in the second half of the year. And that's obviously the I have a lot of things going on. If I have this, then I don't have so much things going on. I can build out. So the role, I think, at that stage of the finance professional is trying to sort of navigate through the immediate need that people have got and trying to build that into the sort of medium-term needs. You're not going to be able to do potentially long-term planning there, because at the early stage of the company, if you're a year, 2 years in, 5 years out is it's just a crapshoot to what's actually going to happen there. But I think trying to get people beyond, this is the problem right in front of me, to what are the next 2, 3, 4 problems that we're going to encounter. And I think that's where, having that experience of going through those processes, the budgeting exercise itself is a bit of a mechanical exercise to get you there. And I always find that, at early stages, the budgeting process is a lot more important than the actual budget. The day after you've done a budget in an early stage company, it's probably irrelevant. But actually the thought processes that go into it in terms of, okay, if we're going to see revenue growth, it isn't just a linear number that we're going to put in. It's like, what does that come from? What are the inputs? What will be needed to have that? In 6 months' time, we're going to continue to see this revenue growth. What would be needed to happen? Well, how many customers would we need? What would we need to support those customers? What's likely to be our hiring plan? If it takes us 3 months to hire someone, well, how many people do we need to have? And do we need talent acquisition because we've got 50 hires coming up and the hiring managers aren't realistically going to have that? It moves beyond the spreadsheets or even software, whatever you build in, to challenging the people in those conversations to get them to think beyond, I'm drowning, how can I solve how can I get out of water?
Dave, at what point you hire a CFO?
What point do you hire a CFO? It's an interesting one. I mean, I've toyed a little bit with a fractional role myself, so I may have a slightly biased thing. I think having a fractional CFO can help you for quite a bit. I think you can probably get through your Series A on a fractional CFO. And as you start to get to your Series B and things get a little bit more heavy, you might want to start bringing someone in there. It will depend upon scale and velocity of what you're trying to do there, and will depend upon things like your investors or other aspects, or your international ambitions or other things like that. If you're growing domestically in the US, you can probably get away with maybe less resources. If you're trying to grow globally or across multiple entities in Europe or so, or you have a more of a global mindset, you might need something a bit earlier, because you end up in a lot of complications which you can avoid by setting things up a little bit earlier in the process, whether it's around tax planning, whether it's around how you deal with customers in multiple jurisdictions, how you can handle recruiting best talent from around the world and not expose yourself to problems down the road. But I think it's the scale and speed is more around that process that I was talking to before. It's you can put in the systems, and your job as CFO is to come in to make sure that no one trips over the day-to-day processes. But it's more around that. It's more around the getting the organization to properly think, which is really hard in early stage companies because everyone is running 110 mile an hour and just trying to deal with everything's on fire.
What do you think companies are, what are the common mistakes companies make between seed to Series C in terms of building finance teams?
Yeah, I think that's good. Yeah, that's a big thing. I think there's a couple. One, and it often depends upon how fast it's taking you to get to product market fit. And product market fit can change for that period of time though as well. I think one of the challenges that companies often have is, VCs are victims of this as well, is this assumption of linearity. In my seed, I've managed to get, a few things over. We've got a few customers in. That got us enough to get a Series A round. At Series A, hey, look, we've still got this revenue. It's still growing. It's 100% this year, 100% next year. This is all happening. And you realize you're picking up all of this early stage interest. And, there's a whole bunch of sort of easier to win customers or easy to win things. And as you start to go down towards your Series C, things start to get a lot harder. Your few things happen. One, your customer profile probably gets more complex, and you start to run into some challenges of things that were good for your early stage customers are not so good now. So now suddenly you've got product teams who are having to think about more than just what a founder's initial vision was, but actually starting putting features which don't seem so cool or don't seem so great to build things out. You're going to have complexity that, your customer base may be getting larger and the procurement processes and cycles are getting slower. And therefore it's a little bit harder to get some of the transactions done and the revenue done. You start to build up a little bit of tech debt, which in the early stages you can kind of just push into the background and not worry about. And now that's starting to be a challenge. You've started to have to introduce things like HR processes, or you've got layers within your organization, and everything just starts to feel like it's slowing down because, you're like, when we were 5 founders or 5 early stage employees, we were able to ship an app ship a feature every few days. And now it's taken us 3 months, 4 months, 5 months. And it's just because your code base is bloated. It's got a little bit more complex. You're continuously always talking about new systems or so. So those are the challenges that you get. And the mistake is not trying to recognize that those things are coming. They assume that everything is linear and all of this is not going to happen. So what happens is you often then have to start to go down a little bit more of a niche. And the challenge that's, I think, in early stages is that there's this assumption that everybody is still your customer. And actually, focusing a little bit more on the ones who are, your ICPs or whatever the other, terminology that you get to there is a hard shift because, in the early days, it was everyone, right? So yeah, it's trying to actually put more focus rather than thinking your focus broadens. Your focus narrows a little bit as you grow.
So IPO is ambition for a lot of founders. How many companies you've been part of that sort of went through this journey getting public?
Yeah, I'm very lucky and very fortunate, and it's surprisingly rare. I know we had a big batch back in about 2021 or so, where a lot of the companies came out public. But look over the last sort of 15 years or so, it's actually surprisingly rare for tech companies to go IPO. The normal path is an exit or a private equity buyout or something like that. I've gone through 2. And I've helped companies sort of prepare for one as well. So, and I'm also fairly fortunate. I've managed to go twice on US exchanges with European software companies, which itself is a little bit more of a rarity and has a little bit more, I should say, spice to the IPO process. So yeah, it's I think you said it's the ambition of a lot of companies. I think it is. I think a lot of companies would need to consider why that's their ambition at this moment. I think if you look at the current market and you look at, a lot of the larger players who are staying a lot public for a lot longer. And that's partly because of the relatively short period of time of the IPO window, but it's also, there are challenges when you go public in terms of, you now live in a quarterly life. Your ability to long-term plan versus quarterly becomes a bit more of a challenge. But I think for a lot of finance folks, they want to have done an IPO. They don't necessarily want to do an IPO. It's been like, I recently did my first marathon, and did all the training, all the build up to it, and all those things. And now I really feel great. I've done a marathon. I love it. I can call myself a marathon runner and stuff like that. Can't exactly say the period of doing the marathon itself was the most enjoyable part of my life. So I think it's the same with an IPO. It's an awful lot of work to being done. And I guess it's slightly different. It's a bit tougher afterwards. You're suddenly a public company, but the actual process of doing an IPO is extremely tough. And there's a lot of work and thought and processes that you need to build into it to get there.
Do you have like any interesting stories from the times when you were preparing for the IPO? I assume that it's basically quite intense process with a lot of deadlines. Many sort of like things are changing along the way as well. As just curious, sort of like if you could share, like
sure. I mean, when we went public with Elastic, it was a really, really tough. We went out in 2018, and it was a really tough process to go through, I guess. We were a Dutch headquartered company, but had majority of operations out of the US. And there were elements where you look at your cap table, and there are requirements of being either a foreign issuer or a domestic issuer on the US exchanges. And we realized that in a short period of time, we're probably going to need to be a US issuer shortly after, or maybe even during the process of IPO. So we decided, okay, we can't go on IFRS, so we'll have to adopt US GAAP. So you're doing this build up to an IPO, which itself is a whole load of issues. You've got to start to think about SOX. You've got to think about PCAOB audits, and at the same time, we're doing a GAAP conversion. But as a Dutch company, we'd still have to do IFRS. So you end up with the need to do both IFRS and US GAAP accounts. And now suddenly you're looking at all your systems and your processes and saying, well, now we need to keep dual books on a consolidated basis, which are both subject to audit. So now, all of the things you think about in terms of your typical IPO build out, which is, how do I build out my systems? You're having to build out those out in sort of duplicate to a certain extent. Now, some of them aren't subject to SOX, so it's a little bit easier. And then we're going through that process, and that itself is challenging. And then we start realizing that we're a subscription with a lot of on-prem subscription, and we're having to go through, we're looking again, similar to the US GAAP, we'll have to adopt ASC 606. Very shortly after we go out because of the timing as opposed to the size. So we might as well adopt that before we go out, because otherwise all you're going to have investors talking about through the IPO process is what would your revenue look like under 606. So again, we're going through this massive change exercise, having to be one of the first companies to go out with on-prem and cloud subscription revenue under 606. So you're talking to the SEC, you're talking to the most senior people in the audit firm. We're talking to the guy who actually wrote the standard in the first instance, trying to manage all these, trying to put in systems in place where a lot of people are selling, a lot of these vendors are selling systems saying, hey, we're 606 compliant, but you can't be because no one's really done it yet. So you're having to reinvent a lot of those things. The conversation with the SEC. Then we start getting into some, how fast can we move to this IPO, because you can see, some of the challenges of the IPO window starting to shut. So you're having to start to accelerate the process. You have to get on file, confidential filing, that starts a certain timeline of things. And, we discovered there's a little loophole in some of the, it was in some weird act, like a transportation act or something like that had passed in Congress. And, the way it works in Congress, in the bills, there's often weird stuff added to the end. And there was this small little loophole that we discovered that allowed you to file with just 1 year worth of financials in order to speed it up. So whilst we're concluding our second year of financials, because we're currently redoing all of the financials, we file with just 1 year. So you end up with this confidential filing, which is now published, I can talk about it, with just one set of documents. We're 1 year in it as you're moving through these things. So we're trying to move really fast, do an IPO, which, I think ended up a $6-7 billion IPO, but you're kind of breaking all the processes that everyone's used to doing. We're used to having, the bankers are used to everyone all coming into these rooms and sitting down and go through paper things. Well, we're a tech forward company. We'll just do everything through Zoom. We're doing everything on Zoom meetings, and the bankers were just like confused over where they should be turning up or not. And you end up with this sort of, everything was just not quite normal, up into the point of, we were looking to, we were opening up a dedicated account with a large bank to house all of the money that was coming through at IPO. And they were going through, this is very late stage, and they were going through the KYC process, and that takes forever. And but they said, if you've got a ticker symbol, then we can bypass all of these. We won't have a ticker symbol till we're public. Like, well, then we worked out it takes 2 days for them to, after you've done your IPO, for the money to come in. So we go out, go public, raise the money. The bank that we're putting all the money in doesn't actually exist yet because the bank hasn't approved it. So we're there on the floor on the IPO. I'm there on the floor at the, on the New York Stock Exchange, on the phone to the bank, trying to get them to, to finally open up our account. So this, I think it was like $250 million can get wired into it the next day. But you're not allowed your phone on the New York Stock Exchange thing as well. So I'm sneaking around underneath all of the various different trading desks, trying to hide from security, trying to get the bank open so we can actually close the bank account to have the funds in current. So yeah, they can be, you'll hear the stories of all the things that happen at the printers when you're there at 3 a.m., 4 a.m. You finish at 3 a.m. Okay, everyone come back at 7 a.m. so we can carry on with the next day. So you hear all those, but there's also all these little funny things that happen on the side as well. It's they're quite an experience to go through, that's for sure.
Wow, this is an incredible story. Yeah, so, well, I guess as with all, like with the entire journey of the company, oftentimes it seems there's a rocket ship from outside, IPO, New York Stock Exchange, and like things are not as smooth as
No, I mean, there's always things that go wrong, and the key thing is always, make a plan, stick with it, change it when it needs to happen. There's so many moving parts, so many different things that you need to have rigorously planned this thing out, but you need to adapt. There's things that are going to go wrong. You can have, anything could happen. Disagreement in order to later on terms of some of the rev rec treatment. You can have some changes which happen on things that you find. There could be changes in the market, things that you have, because it's a few quarters that you go through this process. You've got to be able to deliver the business through that period as well. So, you've got to try and balance that. Is my business going to continue to form? Is something going to happen in the broader market? Does the IPO window shut? Does war happen at the moment? It's all of these things. So it is a challenge that you set yourself off, you go through this thing, and you have to have that resilience built into the team and make sure that the team are very well cushioned because their workload is doubling and trebling through this period of time. The rest of the business probably doesn't even know that this is happening. So one of the jobs of the finance leader is really, really to play this sort of shielding role for the team, absorb as much as you can of the stuff that's coming through so they can get stuff done, which ultimately people will be thankful that they did, but didn't know they were doing at the time. So it can be very challenging for finance teams for this place, more so than probably any other teams, maybe legal alongside there as well. But yeah, more so than the other teams, it's one of the harder jobs.
Dave, when you will take your next company public, is there a chance that it's going to happen in Europe? What's your stance for?
Would I do an IPO in Europe? I would take a European public IPO. I wouldn't do it in Europe. I think it's not for a tech company. The capital markets don't understand it. The exchanges are not. And investors are not properly attuned to have a good view, a good tech company go public on the US market at the moment. I think there's a lot of people who may have different views on it, but you see a lot of the company. I think Revolut are looking at the US exchange now. Arm have just done it. So look at some of the large European companies, they are going to look at your exchanges. We did with Elastic and Talent, a French company and a Dutch headquarter company. I think we're only Talent. I think we're only the 6th French company to go public on a US exchange, but another one in there was another tech company, and it's a shame. It really is a shame. I think I'd love to take something else on the European exchange, but it just doesn't make sense from a valuation perspective, from the way the capital markets work, or anything else like that. And it's it's something that Europe needs to do better.
Maybe shifting the gears a little bit, we'd love to chat a little bit about the tooling for the finance team. Is you building the finance team from scratch, pretty much like Black Forest today? And I guess the landscape of core finance tools has changed quite a bit in the past 5 to 10 years. So what's top of your mind? So how do you think about your stack for the next 5 to 10 years?
Yeah, I think I think it's an interesting one, because I think with the current pace of innovation, I think 5 to 10 years is a challenge. We can think that far ahead. I think if we look at 3 years ago, the thought process that we have, an LLM central to some of your strategies didn't exist. The technology wasn't good enough, and now it's getting there. One of the key things, and it is more of a challenge, I think, for finance teams, is when we look at the implementation of AI. There's the obviously data security risks. Where does it exist? How's it used? How does that feed into training and GDPR and all these other things as well as what data would you willing to put into it? Client sensitive data, all of those other things. Which again, legal and finance teams have probably got a little bit more sensitivity to than maybe a marketing team or something like that. So that's one area. Just you still, regardless of how good the technology is, some of the basic fundamentals around your data, where it resides, who has access to it, how it's used, and some of your basic engineering in terms of how are you plugging all these various different APIs into your broader tech stack. Those fundamentals don't change regardless of what the technology and on the end using it. So I think those are things that you start to think about. The other area on which is a bit more of a challenge for finance teams in terms of what they can and can't adopt to there at the moment, is sort of the black box nature of some of these models. So I think if you think about our various stakeholders, you've got internal business users, you've got helping to guide the business, but you've also got tax authorities, you've also got regulators, you've also got shareholders or whatever else like that. And I think some of the challenges around some of the AI tooling at the moment is the decent audit trail of things that may go in and come out, and how you can validate that. So again, it doesn't mean you can't use them. It just comes back to sort of fundamental finance concepts of reconciliations, of validation data sources, of if you think typical SOC, how do you validate the data through the workflow so it's adequate for you to do it, but also how can you demonstrate it's continued to be correct all the way through that process as well, which is no different to automation, but the AI concept of things can make things a bit more challenging. However, having said that, already using it today, I would spend a lot more time on things if I wasn't using AI. We use Anthropic's Claude quite a bit. Things like document reviews, or things like let me take a perfect concrete example of coming in very early, where these things don't need to be massive. They can just be small. So came in, there's a new company, trying to understand what all of our costs are. We've got a whole bunch of random invoices. There's some sort of QuickBooks system in place with we've got vendor names, and that's about it. Or so we've got people scattered across the world. So there's various different vendors that you recognize, tons that you don't. Just taking all of that, dumping all that data in, throwing that into Claude and saying, give me analysis of all of these vendors, what they do, a brief synopsis of this, and here's my prospective chart of accounts. Tell me where those sit. That comes out in 30 seconds, a minute. And that's the sort of work which a junior level accountant is going to go do, spend tons of time. Your AP clerk is going to have a whole load of processes in around it. So I think as we look at the use of AI in finance teams, it doesn't need to be massive, all-encompassing, huge, I'm going to replace 20 people. Look at it as an assistant. Look at anything that you need to do where it involves, some degree of research, or even, you can knock, if I knock, I don't know, say, for example, I knock 15 minutes off a day over a 260-day working year, that works out 8 days of saving over a period of time. Now, if I multiply that, if you have 5 people in a finance team, you multiply 8 days times, 5 people, you're suddenly into, it gets to real money. And that's just saying it's just 15 minutes of time saved. And the reality is it's a multiplication effect more. But no, so you asked, what am I looking to in terms of tooling that I'm going to build out? Yeah, I think as we look at the current tooling landscape, back in the day, you stick Salesforce in as your CRM, you did NetSuite in as your ERP. There's some sort of go-to, billing systems and go-to expenses systems, and that would be your standard sort of tech stack that you build out. And I don't see that being the company of tomorrow. I think they're all trying to reinvent themselves with AI first, but I think a lot of the new toolings, like Stacks itself, a lot of these new toolings, which are a lot more AI centric, are a lot more lean, which can accommodate a lot of the various different exponents of AI. It's not AI; it's not just one size fits all. Are going to be faster. They're going to be nimble. Are going to work better with redesigned workflows. But a big thing is particularly in finance teams, is it's rules before tools. You need to understand what you're trying to do. And it's not just grab all of the various different, this is a cool AI thing, throw it into the company and, then work out what you've got, which, you asked me earlier, what's the mistake that a lot of, seed through Series C companies do is that, they'll go, I've just had 5 cool conversations with vendors. Let's put all those in, but we don't actually know what we're trying to do here. And I think that's it. You look at AI, but you look at the problem you're trying to solve, and does AI make sense? And don't think about it necessarily as a big thing. One of the, I talked about the difference in the go-to-market for AI companies versus the SaaS companies. Now, this consumption basis doesn't mean you have to spend a ton of money with any individual vendor. The sort of the API nature of it, or the very small consumption basis. You can have 4 or 5 different tools giving you small little assistance here or there. Some of those you'll integrate, some of those will just be a UI. Some of those you may have AI tool talking to another AI tool, and you still put some agents in place there as well. But it is trying to work through all your different processes of what you want to happen. And that doesn't mean, you take your traditional view of quote to cash, but break it down into exactly what you're trying to get done. And then think about the AI tooling landscape around that. An example, we're very early in our sales process. We're mainly founder-led sales. We've got a couple of salespeople in place. One of the things that we're looking at is our CRM. And again, the obvious answer is HubSpot or Salesforce, or drop those in and carry on this process. And you think, well, what's my CRM actually doing? There's a whole load of workflows, and I'm not trying to pretend I can summarize, billions of dollars of value in Salesforce in a couple of lines, but a lot of the old school way of doing things in certainly the last 15 years, you get reps to fill out more and more fields in an opportunity, so you could do more and more different reporting or so. In the world of AI and fuzzy data and the ability to query stuff, it doesn't feel quite so relevant anymore. It feels that I want to have a conversation with the CRM. I don't want to have necessarily tons of fields and then reports coming out. It's trying to work out what do I want from my CRM, not how should I build my CRM because it's always been built that way. And I think Salesforce are doing some great innovations in that one. HubSpot clearly are as well. But look at like some of the tools like Attio or something. They're building those with that being central to the concept of who they are. And I can see that changing a little bit. Klarna famously pulled out Salesforce and put an LM in. I think probably the pendulum swung too far, and it sounds like they're moving back a little bit on that one. But if you get to the fundamental concepts of what's needed, you may build things differently. So it's interesting to see how the landscape evolves, and we're certainly looking at challenging all the old assumptions of the way things are built. But business is still business, so there's still a whole load of these things which are still relevant to today, even with different technologies that open.
What's your prediction in terms of if you were to look at core workflows that finance team is doing, maybe in large enterprise as well? Which ones from those core workflows you think will be automated with AI first? Where sort of like the best fit? So how it's going to evolve in the next I know you said 5 years is too long.
Yeah. Well, I think
5 years.
5 years maybe. Finance teams are traditionally slow to adopt new technologies, despite them saying they probably are. Um, Automation has existed for a long period of time, and there's a lot of automation that doesn't exist in finance teams still. So it's an opportunity to maybe fix some of that. If I look at your traditional finance team, and I'm meaning finance as in core accounting, AR, AP, look at that, or maybe core accounting, AP, maybe. They're essentially a large ETL job. The team exists, it gets data from hundreds, thousands of different sources in variety of different formats, whether it's paper invoices, whether it's CSV files, whether it's automated feeds, whether it's phone calls or whatever. All of these things come in through a variety of sources, and the job of the traditional job of the finance team has been to essentially do an extract, translate, load of all of that into some kind of ERP, and then produce some kind of standardized reports out of the end of it. And then, you've got an FP&A team, which are then doing the analysis over the back end of it. And automation has existed in a lot of that. But one of the challenges with automation, again, depending on the size of the company, has been, automation works on fairly, engineering-led. Well, I have to build a flow. Thing has to drop into there. You've got tools which are doing it. You can look at the evolution of the AP stack. You can look at the evolution of the expenses systems, evolution of things. But it is all about still just whereabouts that data resides and then moves in. So as automation has come on, finance teams got a little bit better with things like OCR and be able to read invoices and populate those things. And it's all been hit and miss in the way they've got it. If you look at the AI space, the idea of the engineering led or the rigid process for the CTL that, I can have these things coming because they're big enough, and then the small stuff I'll still have a human doing. You'd expect more of that to be handled through some of the fuzzy logic on inbound. You'd expect, the responses coming out of finance to be a lot more automated through chatbots or the like. We've all run finance teams where, we're deemed non-responsive, things don't quite work, I can't get information out. My finance team's always too busy, it's always month end, or I've always got the auditors in, I've always got those things. So I think it's trying to take a lot of those tasks and throw them into the new AI world to free up the time to handle all those expense requests, to handle the low-lying fruit. It doesn't need to be, I'm going to replace CFO with AI right now, or I'm going to replace the FP&A team with an AI. But it's all of those low-lying fruits you can start to put into it. The AI tools are getting better and better at data analysis, but they still require you to ask them intelligent questions. I think they are still very good at pattern matching and finding information to give to you. They're not very good at knowing what questions to ask themselves. That may change, but at the moment, I don't expect insights out of my AI. I expect analysis. I expect interpretation. So the finance teams are still going to be there for building out the insights, the intelligence, the value add aspect of things. So I can see that moving. Does that mean I'm going to remove all the clerks and everything? No, but I would probably reduce them in the same way that ATMs reduced bank tellers 50 years ago. It didn't mean that banks employed less people, they just employed people in different capacities.
Yeah, absolutely. So this ETL process that you mentioned, that's what we've seen with many different companies, where you either rigidly code business logic to automate this ETL, and as the business is changing, as you have more upstream changes, teams tend to default to Excel, which is the most customizable tool in the world.
Yeah, exactly. Is AI going to replace accounting and finance teams? Automation didn't. All these systems never replaced Excel. In the end of the day, is AI going to? I'd love to run a finance. It's my ambition. I'm sat here. After this call, I'll go jump on an Excel spreadsheet again. But I'd love to have a finance team. Remember back in the day when we talked about the paperless office, and for years it was never a paperless office, and now actually I think the fact that there's only a few people who would ever have paper in the office. So it has got there, and it sort of took a lot longer than people thought. I'm still waiting for the Excel-free finance team. And that's my crowning glory, is to have an entire finance team running without Excel. of Google Sheets, just to run on, databases, to run on proper logic, to offer proper business analytical tools, all of these things. But I still think we're, a number of years out from that. Yeah.
Dave, how do you think the role of CFO will change in the next 5 to 10 years again? So what's your prediction? Like what is going to change in terms of expectations to the role?
I'm going to say something a little bit controversial here. I think it's going to get less relevant. I think, the CFO has, unless we reinvent ourselves, I think the CFO has had a degree of, I should put this succinctly, a degree of power within organizations for a number of years of being sort of the safeguard of data and being the person who has the decent view of data over the organization and be able to surface this up and have some control over the organization by owning that data within companies. As data is freed up a little bit through LLMs, through internal abilities to potentially query data, a lot more self-serve in a way that makes sense to be able to get a lot more insight. It's not there yet at all with the AI. I think the CFO has the risk of becoming irrelevant if they are just reliant on their position being the data steward. Now, a lot of good CFOs are not that. They're using that insight and helping us drive business, and there's a reason why a number of CFOs move to the CEO state. But I think losing some of that element of being the only person who has this broader visibility of what's going on does run the risk of CFOs, having a number of their things replaced through automation, replaced through those areas. So, this is smaller companies now. So I think as the role of AI develops, the role of the CFO, and it's been happening over the last 10 years anyway, get more and more and more business focused. It needs to be a revenue driver. It needs to be a proper guidance, a proper business-minded person within the boardroom, proper partner to the CEO, needs to be out there and present the product, needs to be able to go out there and understand the full story. Now, that has happened a lot through a lot of tech companies over the last 10 years. But a lot of other companies, it's still less there. And I think the democratization of data and data access and insights means that, the proper, usage of skills rather than just being the steward of the data is going to be essential to keep the CFO relevant as a top level C-suite executive.
A few rapid fire questions to wrap things up, Dave. So what's the one career decision you're most proud of?
I think my one career decision I'm most proud of was to take a break. I took a break, met with now wife, and traveled to Africa, backpacking for a year. And at the time, everyone told me crazy, you never get your career back, and everything else like that. And I think the reality is if you're willing to be hungry, humble, dedicated, and willing to learn, you're always going to be successful in your career. And you can take those breaks. You can do odd career moves also, not too many. But you can do odd career moves, and that's going to be your success is still in your own hands.
What's the most underrated skill in modern finance?
It's still, and it has been for a number of years, it's still storytelling. If you're presenting numbers and talking about numbers, it's you lose your audience. And also talking about the AIs. The AIs can now not just produce the numbers; they can produce a story around it as well. So it's the storytelling with the insights. The AIs are there.
One book, podcast, or blog every CFO should know about.
It's two, I guess. I'm a big fan of Massive Scale. I think Reid Hoffman used to host it for a bit. I think listening to one of the early episodes with Sheryl Sandberg, one about her time at early stage of Facebook, I think was transformative to me and helped me through the early days of Elastic when we were growing exponentially. And I'm a big fan of a guy called Ben Murray, the SaaS CFO on LinkedIn, and I subscribe to his newsletter. I think he's got some great insights.
Fantastic. Thank you so much, Dave. It was absolute pleasure to have you today.
Absolute pleasure to be on this. Thank you.
Thanks for sharing all the great insights, so much learnings from your career, and I'm wishing you all the best in building the most modern and efficient finance function at the AI company now.
Yeah. No, thank you. I appreciate it.
Thanks.